Good evening, everyone. Welcome to tonight's BullCharts user group webinar for remote users and Melbourne users too. There are some of those in the session tonight. Now, for those of you who don't know, Des is an active member of the user group in Melbourne, attends most of our user group sessions, and over the last 3 or 4 years, maybe 5, has presented 2 or 3 times a number of different topics, including a couple of strategy ideas, some of which have made lots of money, which is really good. And some people have tried to emulate that, perhaps with not a lot of success. But that's not Des's fault, because it works for him. Yes, everyone, please make Des welcome. It's over to you, Des.
Okay. Thank you, Robert, and good evening, everyone. What I have here is a presentation I did 2 weeks ago, which is why it says, obviously, the Tuesday, the 19th of July. And as I said here, a trend, my kingdom for a trend. My trading style is I consider myself a trend trader. I sort of work on weekly sort of time frame. That's the mental capacity that I can put up with. And so during the, I guess, the downtime with COVID and the market being somewhat in a parlous state over the last few months, I've had plenty of times in my hands to think about trends, systems, to think about trying to find better ways of doing things. And that's what I've been doing, because I've been sitting pretty much in cash. At the moment, I'm probably, I don't know, 95% in cash. And so it's a good time to be thinking about making systems better. So I just want to go through with you what the agenda is for tonight. I decided to work with you to design a workable trend trading system. And obviously, it's got to be profitable. If it's not, why would you bother? I mean, I enjoy doing this, and playing around with numbers and charts and spreadsheets and mathematics keeps me interested. But at the end of the day, if it's not making money, why would you bother? To do that, we need to define what is a trend. Hopefully, we can come across some sort of agreement to the parameters that would fit into that. Build a system, measure the performance. That means we have to backtest it. I'll show you simply how I backtested here, and then later on, maybe have a few words about the more commercial backtesting engines that are available out there. In terms of whether it's a profitable system or not, you've got to compare it to something. Obviously, you compare it to your bank balance. If it's gone up, it's profitable. But you probably need to compare it to some of the market indicators too, to know whether you're doing better than average. Again, it's no good being profitable, or it's better being more profitable than average than being less profitable than average, but being profitable even by one iota is worthwhile. At the end of that, you've got to decide whether it's worthwhile and whether it's something you want to do. Everything in here is freely available to everybody. Happy for questions, happy for criticism, and in fact, I invite criticism, because if there's something horribly wrong with what I put forward here tonight, please tell me, because I don't want to be living in a little bubble that's full of mistakes and error. The usual disclaimers: this is all my own fault, my own work. I don't have a license, yada yada yada. Okay. What I've decided to do as part of this little exercise was to design a trading system from first principles. So it's also got to be simple. So there's no very complex indicators in this, just a few simple indicators that everybody should be able to get their mind around. It is strictly mechanical. Those of you who know me would understand that I have a bit of a problem with people who put up charts, wave the hand over them and say, you can see here, this is a good place to get in, and this is where I would have got out. That's far too subjective for me. I want to know that you get in on this bar at the open of the next bar, or the close of that bar, and you get out at this bar up here for these good reasons. That has to be testable. And for me, if it's not testable in that way, it doesn't have any credence, any worth to me. In terms of making a system, I wanted to make it, when I say tradable, to Mr. or Mrs. Normal, and that hopefully is those of us around this this session tonight. It's no good having something that's very exotic and esoteric if it's not usable by all of us in our day-to-day trading. So it has to pass that pub test. Components of that are the trade frequency has to be acceptable. So it can't have 75 trades a day, but equally it shouldn't have one trade every 3 years. So it's got to be a trading frequency that's acceptable to you and to me. From my point of view, as a weekly trend trader, for me a suitable trading frequency would be 1 a week, 2 a week, 3 a week, 4 a week, something like that. 1 or 2 a week or 4 or 5 a month, I think is a reasonable trading frequency that's not too onerous. You might have a different view. I respect your difference in view. That's what works for me. Another thing that must come out of the trading system is that, and this feeds into the pub test, you don't want a trading system that comes out with bizarre stocks to buy. When you look at a stock and you put it on the chart, you go, ooh, I can see why it's telling me to do that, but I don't feel comfortable with that. So again, it's got to be in that realm of Mr. and Mrs. Normal. It's got to come up with stocks that are mainstream that you're comfortable with. Obviously, you've got to have liquidity. No good having the best trading system in the world if it's only going to trade $5,000 a week and you can't buy it when you want it. More importantly, you can't sell it when you want to get out. And as we all know, stocks become very illiquid when they start going down. Even quite large stocks can become quite difficult to get out of in the bad times. And that all sums up into what I call the sleepability factor. You've got to have been running a system that you can go to bed at night and not toss and turn. And hopefully what we come up with here will be along those lines. Important to just reinforce, it's got to be measurable, got to be able to back test it. It's based upon trending ideas, so it's not mean reversion. So if somebody said, but why don't you do this? Why don't you do that? Bear with me. The reason is I see myself as a trend trader. I'm putting forward a trending system. And if that's not what you happen that turns you on, understand that too. But that's where I'm coming from, and that's why I put forward what I have here. Predominantly, this is based around a weekly time frame, but there are some daily components and even some longer term components because nothing sits in a vacuum. And we'll reference those other time frames, but it's predominantly thinking in a weekly time frame. Okay, so if you think at the most abstract level, if I want to define a simple trend trading system, start with something really crude and easy. I'll say each month I want to select the top uptrending stocks, buy and hold them until it's time to sell. What could be simpler than that? Buy the best stocks, hold them, and then sell them. Does that meet our needs? Well, as I say, the devil is in the detail. It's simple at first glance, but it does need fleshing out. We need to understand what that statement means in broad terms. Having said that, I do come across people that come up with systems that are that crude and simple and useless. It's got to be well defined, and we have to go through that process. So going down there, when I say buy the uptrending stocks, well, what stocks are we buying? How many are we buying? When do we buy them? When do we sell them? So we have to fill that out. Importantly, at the bottom, I said some decisions can be arbitrary. And I don't have a big problem with that. It's your money. You can do what you like. And if you do have an arbitrary decision, own up to it, fess up to it. So you might decide, I don't want to buy into any coal stocks for environmental reasons. That's fine. So coal stocks are right. That's an arbitrary decision. If you make it, own up to it, and then you can legitimately put it into your system because you've put that level of credibility around your decision. So here's a tighter definition of that strategy. I didn't mention before, but it is a rotational strategy. It talks about every month getting rid of stocks. So think about this. I'm saying on the last trading day of a month, and think of it in terms of the SX, the last trading day of the month after the close, scan from our universe of stocks. What's the universe of stocks? To be decided. Select the strongest from those stocks. To be decided. 5 stocks. Why are we picking 5? We'll look at that as well. In equal dollar terms, why are we doing that? Importantly, we're only going to buy stocks that are uptrending, we have to define what that is, and we're going to buy those stocks that satisfy that criteria. We'll buy those stocks at the open of the next trading session. We're going to hold those stocks until they trigger an exit to be decided, or until the last trading day of the month, and then we're going to sell in the as near to the exit of that day, which you can do in Australia if you sell into the closing auction, or you could have a different criteria, sell at the open of the next day. But for the purposes of this exercise, I'm saying sell at the close of the exit day, and then record the results so we compare against a suitable standard, which we have to define, and rinse and repeat, rinse and repeat. So that's a better definition of what the strategy is. But even at this level, there are half a dozen items that have not yet been defined, and we need to work our way through ticking those off one by one by one. So what we're doing here is getting rid of those hand-waving bits of the exercise, saying buy down here at the bottom of the market and sell at the top of the market. That hand-waving does upset me somewhat. So let's look at how we define those things. There were some things in there that were easy to tick off. I've said buy 5 stocks. Why 5? I put it to you, it's a small enough number to be manageable on a weekly time frame. It gives you some limited diversification in terms of risk. 5 stocks that you're handling, not too much admin effort. And the results aren't too bad. So I'll look at that later. I have done some work on having portfolios of 1 stock up to 10. And when you work on 10 stocks and you look at where the aggregate is, around that middle area, around 5, seems to give some sort of stability, slightly less volatile than buying just 1 or buying the 10. When you buy 10, you tend to be pulling in some of the less well performing stocks. So 5, I think, passes the reasonable test. But I say here, it is an arbitrary decision. Fess up to that. 5 is an arbitrary choice, but at least I can point to reasons why I can justify that at a gut level. I've also said here, go to buy in equal amounts. So if you get $10,000, you're buying 2,000 of each, and whatever your total portfolio size is. Again, it's easy to manage. Lots of people will do it this way. You don't get the complexity of going into position sizing, but again, it is somewhat arbitrary. You could decide you want to buy 5 stocks and you want to put 25% in the first one, 17% in the second, and whatever. You can do what you want there, but I've said equal amounts makes it easy to manage and is reasonable. The universe of stocks needs to be, as I say here, big enough to give you enough stocks to buy. So when you run the system, you don't want to run a system that throws up stocks once every 6 months. It needs to be able to give you choices on a regular basis, not necessarily on every time you run it. It's legitimate that your system could say, at this moment in time, there are no recommendations. And so for this exercise, I've taken the ASX 300 and the S&P 500. In terms of liquidity, the S&P 500 is, for all of us, is far, far more than we could ever need. And the ASX 300 is reasonably good. There are times when some ASX 300 stocks are a bit thin on the ground, but you can normally get out. You may have to slip your price a little bit, but those are it's a reasonable universe in which to play. And in terms of comparing performance, I'm using the XJO for the SX. I realize that's the X200, and I'm using the SPX for the USA. So that's what I'm going to measure against. And in fact, sometimes, I'm not sure about this presentation, so sometimes I'll measure against the NASDAQ, which is included within the SPX. Okay, so now we're going to pick what is a trending stock. We're going to define what is a trending stock. And there's any number of things that you can pick. I said earlier on that I didn't want to have complex indicators in here. I want to start at first principles. I want to start at some simple components to make up my trending part of this system. There are some up there. Obviously, it's not an extensive list, or there's only a few up there. Would anybody like to volunteer what they would like to see as a part of their trending indicator?
HHHL.
Moving average.
Slow.
Yeah. RSI also.
Threw in suggestions, and there are some in the chat box too.
Okay. All right. So in fact, I've cheated a little bit on this one, and I've chosen 4 criteria to build my my trending indicator. As I say here, the first one is price. I take the view that if the price is going up, you've probably got an uptrend going on. Certainly, if price is going down, you probably don't have an uptrend, and price is probably the most simple component you can put into an indicator. So I'm saying price. I use a short period of 5, a 5-bar moving average. I use a weighted moving average that just happens to be my. I like weighted moving averages on the close, and I'm saying that the price is moving up if the latest WMA5 is greater than the previous. So I'm just looking at the last 2 bars, the last 2 points on the graph, and if the price is moving up on the last 2 points of the graph, I'm saying that's good enough for me. Price is moving up. Now, it doesn't come as simpler than that. I put it to you. If you want to measure a trend, you need 2 points at least, and I'm using the last 2 points on the price chart after I've averaged them using a WMA5. Momentum, probably the best recognized momentum indicator is MACD, and I'm saying that when the oscillator is greater than the signal line within the MACD, I'm saying momentum is moving up. I use 5-12-9 rather than the 12-26-9 because I think that moves a little bit more quickly, and for me that's a better choice to make. So if the oscillator is bigger than the signal, I'm saying momentum is rising. So I'm only looking again at the very, very last bar, the instantaneous where we are in the market today. For analysis purposes, I may want to look back over time, but for a decision purpose, do I want to buy this stock or not? I'm only interested in what it's doing today. So that's why I'm only looking at the last bars. Volume. Those of you that know Ilya would know that he's a very big fan of volume. And in this indicator that I'm building, I'm saying I want to buy only stocks where the volume being traded is on the rise. I don't want stocks that are trickling on the bottom with no volume whatsoever. I actually want the volume to be rising. So I'm saying, look at the last 2 bars of the volume chart, and I want the latest bar to be greater than the previous bar in terms of volume. A little bit of commentary: beware the last bar. When you're using volume bars midweek and you're using a weekly system, your last volume bar will not have all of the will not represent a full week's value. So you need to go 1 bar back and use the previous bar until you get to the end of the week. That just says a little bit of jiggery pokery within the code. It's trivial, but it's important. I mentioned here, I will also flag in some of my indicators when a volume has broken out by 30%. And that's just, I say it's worth flagging, but it's of interest only. It's not built into the indicator that I put here. But in terms of looking at charts on the screen, I'd like to know if a chart, a stock has broken out on its volume. And then the extra one, if you like, is a bit of belt and braces. A golden cross moving average of WMA3 being greater than the WMA12. For this to occur, it almost certainly has been covered by some of the other criteria above, but I use it as a fail-safe that if I don't have my WMA3 greater than my WMA12, I'm not going to say that that stock is uptrending. And you can see in brackets, I put the first letter of each of those criteria, and I call that my PMVBX or PMVXB. I drop out. Trust me, this is simple. That is the code that calculates all 4 of those criteria. And you can see that within brackets, this is BullScript code. Within brackets, it's commentary. So you've got a couple of lines there to do the price is rising. You got 3 lines there that do the MACD is going up. You've got 4 or 5 lines to calculate whether the volume is rising or not, as the case may be. Single line to calculate the WMA 312, whether it's up. And then importantly, the final line is saying we're in an uptrend if the price is rising and the MACD is up and the volume is rising, and the WMA 312 is up. So that is the core code that drives everything going forward. There are 4 components to the uptrending indicator, the PMV indicator. There are 4 components. This is the code that calculates those 4 components. And for those of you that are not familiar with BullScript, you might think that's a horribly complex thing. For those of you that are familiar with BullScript, I think will readily see that, oh yeah, that's common sense. I understand what that's doing. So let's see how that looks on a chart. And of course, when you put normal indicators onto a chart, you get all this this confusion and complexity. And as those of you that know me, I hate complex charts like this, so I put it all back into ribbons. So you see down the bottom, we've got the 4 components: the price, MACD, volume, and the crossover. Those are the 4 components we've just been discussing. Green is good, red is bad, obviously. And then I have a combined PMV ribbon, which is all of those put together. So you'll see that when we have everything is green, lime green, you get that dark green. The blue there includes the breakout, and you'll see that when we get lots of red, we get red, and oranges, some greens and some reds. So pretty straightforward. In running my screens, in fact, I dropped the bottom ones off altogether because I'm not really interested in that. I want to know what the combined indicator is telling me, so I just use that top line. So in fact, there's an example. So that is the combined PMV indicator along the bottom of the screen. I mentioned earlier that I'm really only interested in the last bar of the screen. You know, I'm buying here, I'm not buying here. So I'm really only interested in what this indicator is doing at this last bar. And to make it easier, instead of drilling down into this, when I, within BullCharts, if I put my mouse over the bar, over the ribbon, it will pop up what the status is of that ribbon. Obviously, this is a PowerPoint, so that won't occur. But I put here the PMV BX value, and at the moment for this chart, none of PMV is green, so that's why we've got this pink color, and a couple of other numbers I put here for my own purposes. Afterwards, we can look at that when we go, if we get time, and look at BullCharts itself. Now, again, some people be aware that I quite like looking at multi-periods, even though I consider myself a weekly trader. This is that same PMV indicator on 3 time frames. So the top one is monthly, weekly, and daily. And I put the proposition to you that this stock here, ASB, is uptrending according to this criteria. It's actually breaking out according to this criteria on the weekly time frame, and it's also breaking out on the monthly. So not breaking out, it's trending up on the monthly, and it's trending up on the daily. And I would say this chart therefore represents a strong stock. It's uptrending in all 3 time periods, and I put it to you that this makes a better choice for stock to buy than one that's uptrending in only 1 out of the 3 or 2 out of the 3. So those are the sort of stocks I want to look for. Those that are displaying this PMV characteristic on all 3 of these time frames. And that's what I look for. So this is into BullCharts now, into the scanning process. I define 3 scans, 1 for each of those 3 time frames. So first of all, I scan for the daily, then I scan for the monthly, and then I scan for the weekly. Over here at the panel at the back, the criteria I say is an uptrend is true. So I'm saying if we're in the uptrend according to the PMV, I'm saying I want to select that stock. And here in the middle of the screen on the right-hand side, this is the code that does that calculation. And this is the same code essentially as I showed 3-4 slides ago. So you can see we calculate the price is rising. We calculate whether the MACD or the SMACD is up. We calculate whether the volume is rising and the MA312. And then we say, we're in an uptrend if MA312 is up and the price is rising and SMACD is up and volume is rising. And we return that as the result. So those of you who are all familiar with the scanning process within BullCharts should find that very, very comforting, very straightforward. You can see when you make the criteria, I'm just saying uptrend is true. And that will give me all of those that are uptrend, that is, or PMV is true on the daily basis. I then do the same for the weekly. Sorry, then I do exactly the same for the monthly, obviously a different time frame. And for the weekly, I do almost the same, except on the weekly, which is the third of the 3 to run, I add this other criteria where I decide on what is the strength of the stock. It's all very well to pull out what we think are the top trending stocks, but how do I differentiate which one is the strongest of the 20 or the 5 or the 3, whatever it is? How many stocks come through? I just want to pick the top 5, and therefore I have to rank them. And I rank them according to the code here. I use the rate of change, and I use a rate of change of the close of a 10 bars. And then I take the moving average of that, the weighted moving average of that over 40. And I call that ROC 1040. So I use the rate of change 10 and I smooth it by 40. That's the code, small piece of code within the bull scan. It forms the second criteria within the scan. It's on the weekly chart because I'm only doing that for the weekly. So think scan for the daily, scan for the monthly, and then scan for the weekly. That's the third thing I do. And those, again, if you're familiar with scanning, tab 4 allows you to sort according to the strength. So I said, select the strength, show the first 10 rows or 5 rows, how many you want, and sort those descending, and that will give you the top performing stocks from those that were selected of the daily, monthly, and weekly timeframes. And when you do that, this scan was done a little while ago. There you go. There's 5 stocks. In fact, they've been ranked the other way around. But I'm saying the PMV uptrend is true on the weekly, and the stock strength is greater than 0. And then we sort according to that. For those of you who want to know how to do the daily, monthly, weekly together, you select all 3 from your scan list and say run. It'll pop up this little window that says, I'm going to run them in this order. If you want to change the order, you can. The important thing is it uses the results from this preceding scan to go into the next scan. So the output from the daily scan goes into the monthly scan, and the output from that scan goes into the weekly scan, and then the weekly scan does the PMV uptrend and checks on the stock strength.
I think it's useful to say that what you've just described about the 3 scans consecutively is, as it's shown in the fainter bit of text in the top of that dialog box, is a multi-scan arrangement. So people can always do a search through the knowledge base for how to do a multi-scan and how it works.
Okay, excellent.
And there's a question in the chat box. How do you bring up the multi-scan page? Maybe we can demonstrate that later when you get to your bull chart screen.
Yeah, that's probably, yeah, that's the best way to do that, yeah.
Okay, we'll answer that.
Happy then. Okay, so where we are now is we have described a process where we can generate an indicator, a PMV indicator, which is a trend indicator. We're going to run that on 3 time frames to get those stocks that are uptrending on all 3 time frames. And we have decided how to rank those stocks according to a strength criteria, and I use a rate of change. You can use whatever you want for that. I'm currently using a rate of change 10 on 40 for the moving average. Depending on the time frames, depending on the stock market you're in, depending on the health of the market. If I do back tests on this, sometimes 1040 is better, sometimes 515 is better. You know, you can you can really twist your mind up getting the best conditions, optimizing those numbers, and you'll keep just chasing your tail. At the moment, I find 1040 isn't bad and works quite well for me. Everything in this presentation is on 1040. But what about the exit, I hear you say? Again, for this exercise, I've kept it simple. I'm using a rising trailing stop with a fixed percentage from the initial buy price of 6%. So if it drops to 94% of the last close, the buy price, and then rising on the close, I'm going to get out on a daily chart from one of the 5 stocks that we've bought. And if I'm still holding the stock at the end of the month, I'm going to get out. If you then run the criteria and one of your stocks comes back in, you don't have to sell it. Obviously, you can roll it over. But again, keeping it simple. The reason it's this simple is I'm going to do the back test using an Excel spreadsheet, and so that we can all understand intimately the way that works. And to keep it simple, stupid, I've done this right down, but it still gives quite good results. What I also have done is I've built a little indicator, very small and very simple, just to help with this calculation. So you can put up a chart, you can draw the 2 lines at the beginning of the month and the end of the month, and you can pull from the chart what is the percentage rise and fall of your selected stock over that period. And there's an example. So that's the ASB that we had earlier on. If you look at the top bar, this is the month of May, from the 2nd of May to the 31st of May. 2nd of May was a Monday, 1st of May was a Sunday, so it doesn't count. So if I want to find out how this stock performed over that period, so from the 2nd of May to the 31st of May, it in fact gave an exit on whatever that was, about the 4th bar in. This is a daily chart. It gave an exit, and the exit was at $193, and that was 4.47% drop in price from the buy price, the open in here, which obviously is hidden by the red bar. If, on the other hand, this stock had not generated an early termination, but had gone all the way to completion to the end of the month, so you kept on going until you got to here, in that case, this would have shown a drop of 1.99% after the 30 days. So that's all I do when I start putting out this performance information. I just put in the dates that the month I'm interested in. This again is for back testing for the current month. You don't have to go through this because you're there. I put in the dates and then I just put in the stock code, and that will tell me how the stock performed over this period of time. And then I take one or other or both of these figures, depending what I'm doing, and I just put that into a spreadsheet, which we'll go into later. Let's just go back one. So quick reprise, we know how to select stocks, we know how to get out of stocks, and we know what price we're getting out of a stock so we can back test. But what about the market? I am firmly of the belief that there are times when you need to sit out of the market, sit on your hands, and in fact, I believe this moment in time is one of those times, and I'm not in the market because I believe the market filters are just so bad at the moment. I'm not prepared to be in the market. I have played around with all sorts of market filters, trying to find one that is the best. And I don't think I've found the one that's best, but I've found the one that's best for me at the moment. And this is a modified multiple moving average. It's a Guppy MMA, but it's been somewhat butchered by me. And I use this to decide whether the market overall is going up or going down. And I use this to say, if the market is telling me not to be in, I'm not getting in. And when the market says get in, I'm happy then to take the 5 stocks that I've selected. I'm happy to get into them. And you can see, if you analyze the Guppy multi-moving average picture, there are 4, in my view, there are 4 areas of interest. There's this area here where all the short-term moving averages are clearly above all the long-term moving averages. And I've colored that area in dark green. And that, as I say here, it's a definite clear up gap. There's a gap there. This is an uptrend, and it's clearly in an uptrend. So I color that green. That's one component of this picture. The other one is the red area, and that's where all of the short-term moving averages are all clearly below and distinctly below the long-term moving averages, and that's this red area. There's another few red areas around, and this is when the market clearly, to me, is in a downtrend. And I said you can say market or stock. This is the XJO, so I'm talking market here. So the red area says you're in a downtrend. The green area says you're in an uptrend. And then there are two intermediate areas where the short-term moving averages, the long-term moving averages are not distinctly separated, but they're actually overlapping to some degree. And there are two forms of overlap. There's the touching overlap, which is this orange component just up here, for instance, where the greens have come down into the reds and they're just overlapping and grazing, they're touching, but they're not penetrating. And then there's the penetrating, the overlap with penetration, which is, you can see the next bit here, it gets a little bit hazy, but here the reds have penetrated, so the long-term moving averages have penetrated above the short-term moving averages, and they've penetrated, they're overlapping and penetrating, but not so far as we have a gap. So I characterize this chart into four areas: clear up gap, clear down gap, touching overlap, and overlap with penetration. And true form, I turn it into a ribbon because it's much easier to see what's going on. And when you look at the ribbon, it passes the sensibleness test. So you see the green bar here says this is when I believe the XJO is clearly in an uptrend, and it turns off about here. And from that period on, it has not been uptrending. In fact, there's a little green bar here, and it did give a false breakout, and it did actually does give a green uptrend just in here. I actually traded that and lost some money on it. But by and large, I think this does tell you quite clearly when the market is uptrending or downtrending. And I use this now to tell me whether to get in or out of the market on a more general sense. Okay, that really concludes the system strategy in toto. We use the multiple moving average to tell us whether to get in or out of the market. We use the 3 scans with the strength indicator to pick the top 5. We buy those stocks. We either hold them for the month or we sell them somewhere during the month when we get that 6% drop down. And the reason, by the way, I use 6% is, for me, if a stock goes backwards by about 10%, that's when I begin to get a bit nervous. I'm saying, maybe I shouldn't have bought this one. If you want to get out at 10%, you probably want to slap yourself around the ears when it's 6% down to give you time to get out and to allow for some slippage. So that's a bit of an arbitrary decision, but that's the reason behind my arbitrary decision as to why I use that. So if we look here, this is obviously a component of a spreadsheet, Excel spreadsheet for November 2021. The scans came up with these 5 stocks. This line here is the XJO, and so in November, the XJO went down by 0.93. LKE tripped out at minus 1.03%, and if you kept it for the full month, would have been down 10.72. Likewise, AEF would have given you either plus 1.8 or plus 604 if you'd kept it. The exits that came out early were an average loss of 3.06, If you'd kept to the end of the month, your average loss was minus 5.75. I then roll those through into an annualized result for the year. So at this time in the year, after that 0.93 down in the XJO, it's showing a year to date of 109.9. The two trading systems would have shown 135 or 177 year to date. We just carry those figures forward until we get to the end of the year. These are the end year numbers: 125, 174, and 112. I then summarize these numbers into this box at the bottom right-hand corner, and you'll see the box has the four colors of the four multiple moving average possible entry colors. So I'm actually running 4 systems in parallel here. 8 systems parallel. So if I decide I'm only ever going to get in when my multiple moving average is green, therefore I only include these figures when they're green, like here. But you see, for yellow, I don't include any component towards the end year result. If you had entered, got out on the first exit for every month, only for the months that it was green, you would have made a gain of 100. Sorry, you would have ended up with 137. Take off the 100, you would have made a profit of 37.97%. If you'd chosen to keep the exits to the last, you would have made a profit of 99% on that. If, however, you'd chosen that you were going to buy on the green or on the orange, you would have slightly different numbers. And if you'd been really gutsy and decided you were going to go all in no matter what and never ever take the MMA as a signal, you were going to go in no matter what, you would have made these numbers here, 25 and 74. If you take off the XJO over this year, made 12.76. If you take that off, this delta column is the gain that these systems provided over and above the stock market for that year, for the year of 2021. Any questions? That little bit to grasp there. It's a spreadsheet. One of the good things about spreadsheet, you can do this. You can put these numbers in. You can see what the result is, and you get that gut feeling of credibility. Yeah, I know where these numbers came from. This makes sense. This is not some black box back testing tool that I close my eyes and trust to God in. Any questions? Okay.
Des, David
Yep.
Woodside.
Hello,
Des, I want to thank you for a brilliant presentation. Look, it's really fascinating, and I'm really glad that you've lifted the bar, so to speak. A fascinating presentation. Just a bit of background. The ASX did something similar, but much more basic, back about 2014, and they released a YouTube video, and they were doing it quarterly, and it was run by Julia Lee, who was then with Bell Potter. So I suppose what I'm really saying is there was a basic system, but you've taken this to a totally new level. Thank you very much for a great presentation.
Thank you. So what I have done here is that slide there, that's a snapshot of a component of a spreadsheet that I have. This spreadsheet has this analysis for multiple years, for multiple markets, and also for multiple trading systems and variations on a theme. For this purpose, what I've done, and these numbers would be around the 18th of July, because that's when I cut these slides. These are a summary for the SPX and the XJO for the years of 2020, 2021, and year to date for 2022. So these are 2.5 years of data analyzed in that format, and I'll just walk this through with you. First of all, the two bottom panels are derivatives of the top. So the top panel is the results, the raw results as per the previous screen. that little box of the colored numbers. For top line there, USA 2020 SPX, the index that year went up 16.91. I'll say a word about that a bit later on. And those are the numbers you would have got if you'd bought only in the green that says you're only buying when the market is definitely moving up. If you sell on the first exit, you would have made 12.97%. Here's my cursor. Sorry, 12.97% or 17. If in that year you'd gone all the way through and ignored the multiple moving average market indicator, you would have got 12.46 or 23.1 on the SPX for that year. And you do all those numbers, you'll see that in the raw data, there are only 1, 2, 3, there are 5 out of 48 numbers that are negative, and they're only slightly negative. So this says that there was a positive result here 90% of the time. And that's not bad in terms of raw performance. And when you look at the bad result, it's come in the middle of this year if you'd chosen to continue to trade. If you'd chosen to sit out, so that would say you'd made no money and no loss, you'd be zero. If you'd chosen to trade come what may, you actually would have beaten you'd have beaten the market. You'd have beaten the market. You would have made a net profit of 3.8% or 4.2. The next panel is comparison to the index, and you'll see here that if you compare it to the index, similar in that there's only 4 rather than 5 are negative. So this is 92% better off than the market over that whole trading period, including interesting for this year as well. And you'll see that if you do nothing, you'd be 11.3% better off than the market in the XJO this year. Why? Because the market went down 11.3%. That 11.3%, bear in mind, is the number from 2 weeks ago. So it's not that at the moment. It's about 8.9% or whatever. And then the last one is, I think, somewhat more tantalizing, more juicy. This says what is the cumulative return on the US market or on the XJO over that 2.5-year period. So if in the USA year 2020, if you made 12.97 and then compounded that with 35 and then 0 because you were sitting out, you would have had a 53% rise over 2.5 years. And likewise, you would have had good results over that period. For the XJO, you would have had some very, very respectable results over that period. So those are the results that come out of the system, according to these spreadsheets. So they're providing I haven't made too many errors. There may be the odd one in there, and according to BullCharts data. And there's a big caveat perhaps on that. So summary. I think I've described ISA as simple mechanical system. Some people would say simple, you've got to be kidding. But if you work your way through it methodically, and I think as chartists we are of that ilk, I think you can see, yes, there's a process. At every step, there's a defined do this, do this, do this. There are no points where you have to make a call, do you, don't you? You have to make a call as to which of those 4 types of systems you want to use and whether you want to leave early or late. That is a design criteria that you have to decide on, but you've got all the data to show you which is better. At a high level, the results say there is a 25% absolute annual return across all back tests. So whichever one you take, the average of all of those is 26% better off. And that's 23% better than the index performance over that period. If you have the wherewithal and the strength of character to run this for the 2.5 years that we looked at, which is some of the most turbulent times in the market, you get very strong compounded results. An observation here is waiting till month end may give better returns but at greater risk. So some of the better numbers are in that red area, but some of the numbers are a bit scary. And if you look back through the year in question, some of those red months are all over the place. So it's higher risk, higher return. Oh, surprise, that's the stock market. So you might want to just think that through. I haven't done a lot of analysis on that, but I've looked at it and that's my gut feel. The corollary of that is patience may be a virtue in turbulent times. If you're prepared to trade that red one, you could get quite good results. But the other one that this covers is that maybe sitting on your hands in turbulent times is quite a good thing, and that's what I'm doing at the moment. At the moment, I'm sleeping much better than I was in January, February. The back test that we've done, I've shown you 2.5 years, so that's over some pretty torrid times. I have back tested further back, but I'm loath to do that with BullCharts data because I'm well aware of survivability bias and things like that. And I think I need to redo this then in the context of Norgate data and do a much more rigorous analysis. You've got lots of questions can come up. Why did I use the parameters I used for the MACD? I gave you my reasons, but you could optimize that. There are all of those numbers, 10, 40. You can optimize that. You can go to town in optimization. And that will take forever, perhaps, but it's worthwhile doing in some. All of this stuff is available to you. I'll show you some things on the optimization a bit later on. Conclusion, I think the numbers look interesting. They're a bit scarily good, so I'm at the back of my mind, I'm still thinking about that. I do believe that PMV concept as an indicator has worth. If a stock is going up according to PMV and it's going up on 3 time frames, it's probably at least having a look at. Sometimes you look at a stock and you look at the PMV and it's gone through the roof, and you look at it and say, oh, there's something happened there. It's a takeover. One of the time frames has gone up, 40%. For instance, a Kogan, there'd be a good example. Kogan would jump up in the PMV on one of those time frames. Would you run with it? Your call. I believe the moving market, multiple moving average as a market trend filler, I think that has worth. I think it has proven worth. As I said, each optimization is possible. I'm currently porting this to RealTest, which I think is a superior backtesting tool to AmiBroker. One of the problems with AmiBroker and RealTest, all these is multi-period testing is a bit of a bitch, and I'm just working my way through that. But I'm happy to show some of the work I've been doing in that area, because it's the rigorous testing that these packages do give you some hope for good outcomes. Happy for questions.
Des, Alec here. One of your early slides, you highlighted the issue of volume if you're doing weekly scans in the middle of the week.
Yep.
And I notice you are using, or you're not using rolling periods. Have you ever used rolling periods in the weekly scans?
Yes, and in fact, I think, did you raise this at a previous webinar, which then Robert replayed to the Melbourne group some time ago, that generated a fair bit of discussion about rolling periods versus weekly periods. I have played with rolling periods and haven't been able to get my mind sufficiently well around it and get consistency of results to allow me to go further down that route. It's not really an issue because you're running your test on the Friday, sorry, on the weekend. If you're doing weekly scans, you're running those after close on the Friday, so you do have a full week of data. But if you pull up, pull it up midweek.
Yeah, that's quite right. If you're always doing it on a Friday, but if you're wanting to do it on, for example, the last day of the month, that can obviously fall in the middle of the week as well.
Yep,
and
quite right.
The issue of volume starts to come up, because I've struck this in some other work that I've been doing myself, and it does sort of cause some problems. And I have tried the rolling periods, and I'm reasonably comfortable that they do seem to give you the right result. The only problem is that when you look at the weekly chart, it doesn't actually align with the rolling period that maybe you've done the scan for.
Well, that's the problem, because the rolling period doesn't apply to all your indicators in stock, because they're still tied to the time frame you've got. So
That's right.
you've just broken the symmetry of the work you're doing. So short answer, yes, I've looked at it and decided too hard basket, or I can't make it work. I'm not clever enough. But
Yeah.
I'll show you again. We'll look at some of the volume charts as well, and you can see whether it works or not for you. Okay, so I'm going to close this down. All right, so no surprises here. This is BullCharts. I'll show for those that, oh, wrong one. So these are the scans that I have. I usually have a lot more, but I've slimmed it right down here. So if you look at here, daily, there's the S300 PMV daily, AX300 PMV monthly, AX300 PMV weekly. Those are the three scans that I developed and I showed on the screen earlier. So let's click on the daily. If you look at the daily, PMV uptrend is true. And if I click on that criteria, I call it, the name is PMV uptrend. Oh, what a novel name. So that's just so that it comes up in the title bar here. And when I edit that, that's the piece of code that I showed earlier on. So is the price rising? Is the MACD up? Is the volume rising? And then I say uptrend is 312 is up, price is rising, MACD is up, volume is rising. And then from the terms of the scan, I present that result uptrend as a result of this scan. And that allows you to test whether it's true. So that is the scan in its entirety. This show PMVX is just something I put there. I'll click it on here just for demonstration purposes. Securities I'm running against is the SX 300. And if I run that, you'll see that it goes through all of these stocks, pulling up those that are PMVX or better. So that tells you what the criteria is. PMVX or PMVBX says there's a breakout in that particular chart, but I don't use the breakout in any of these calculations. So that has found 99 stocks from 304, and those are uptrending on a weekly basis. Okay. The monthly one is exactly the same, just is the uptrend true, except it's on a monthly basis. And then the weekly is the uptrend is true. I measure the stock strength. So the stock strength is there. There's the rate of change 10 smooth by 40. I present that as a result. Oh, okay. And I'm checking that it's greater than 0, because why would you want to buy a stock if it was going down? If the stock strength was less than 0, it means that its rate of change is going down. I don't want that. So I'm saying I want it to be uptrending on a weekly basis. I want it to be stock strength greater than 0. I also show what the MACD value is, and I show what that PMVX value is as well. That's just for me, for my curiosity. Okay, so when I want to run this at the end of the week, or whenever I want to run it, I'll say I want to go. I'll press weekly, so I highlight all three. I right click and hit run, and we get this little box comes up that's saying you want to run PMV daily, PMV monthly, PMV weekly in this order. And I'm going to use the results from the first scan to go to the second, and the results from the second to go to the third. That's a very clever, very smart way that BullCharts allows you to run these multi-period scans. I haven't found it anywhere else, and I wish I could find it in other places. So that's what we do. Now I'm going to run that, and you'll see what happens. So here it's running scan number 1, which is the daily scan, and it's scan 1 from 3. And it's done the first scan. Now it's doing the second scan. and there's not very many coming out of this. So there were none. There was one that came out of the second scan, and then it went to do the third scan, and it found none from 3. And that says at this moment in time, there are no stocks that satisfy that uptrending criteria on all 3 time frames. If you want to look, and you do this for backtesting, if you want to look at other time frames, you would go into your criteria, and let's run that scan as an example on the 31st of May. And you got to do it for all 3 time frames. Do the same for the last one. Now we're going to run those. So these are running the exact same process, but we're running it as of the 31st of May this year. Scans for the daily. This is the monthly. Right. And at that time, in the 31st of May, there were 2 stocks, Syrah and Nib Holdings, that actually passed that test for all of those. And that this year, there's not too many stocks come up because the market's been a bit against us. But those were the only 2 that I'll put on something because here is the trend. But fair enough, that is at the last bar there. So if I put up the ribbon and can take, there we go. So here's the ribbon for that time. This is weekly, and you'll see that if you put the cursor on the ribbon, it comes up with what the ribbon is showing. So the pink is PM and V are all down. The red is PM and P and M are down, and volume is up. If you think that's pathologically the worst case you're going to get. So the volume has gone up, but my stock has gone down. Green, light green or lime green is 2. There's that P and M is up, but volume is down. Sometimes you'll see P and M. There's M and V. So the green one is 2 out of the 3 are up. I mean, this could get horribly complex. The blue is there's a breakout in the volume. If you look at the volume, you'll see that where the blue is, the break, you can clearly see the volume bar is well above the moving average. So that's a breakout there. Okay, so that's how I run those scans to find those. Oh, and to show you what I then do in terms of finding out how they performed. It was 31st of May we did that. So from the 1st of June to the 30th of June, you got to tickle the, oops, you got to go daily. You got to tickle these bars to make them work. I'm not sure why that you have to do that, Robert, but that's just one of the things you do. Once you've tickled them once, they're good. So those bars do the 1st of June to the 30th of June. And this says that for this stocks SYR, it says if you take the early exit, you'd be getting out at 164, which is minus 9% down. So that's well more than the 6 because it's dropped down. Underneath that, I'm pretty sure there's a gap down. And it exits on the open. But if you'd held it even worse for the 30 days, you'd be 31% down, which would be down to here. So that in that instance, that would be a terrible trade. So, and that's I'm saying, if you choose to go in against the recommendation of the market ribbon, you'll get some pretty horrible trades, but you'll get some nice trades. So what I've just done here is I'm just putting the multiple moving average ribbon onto this bar. It's doing a bit of thinking. The limiting criteria for me is how long it takes for some of these things to come up. So here you can see that this is the XJO multiple moving average. So this is not the multiple moving average of this stock. This is the multiple moving average of the XJO. And at the time that the 1st of May, when this stock came up as one of the top, as it turned out, just one of the top 2, the XJO was in pink mode. So it was in that penetration mode. It was in a bad state of health, in my opinion. And I would say that if you do the MMA, well, it would have stopped you getting in there. And in fact, you can see that as of now, I mean, it says if you want to stay out when it's red, you've been out of the market from, well, the last time it was green was that false rise at 2nd of May. Okay, so that's how I calculate all those things. What else is there to show? Let me just show you this. If I've been doing some work with Real Test, which is, but those that know Amy Broker, the back testing in Amy Broker, this is very similar. The results look almost identical, but it's still a work in progress for me. So here's a little piece of code, and it is really quite concise, that says the entry setup, that's when you buy. And buying with the MMA is green. The position rank is less than the position I've room to buy it. And I'm going to exit after I've held it for long enough. For bars held is greater than weeks to hold. Weeks to hold is 4. And I compare it to the XJO in terms of performance. Up here, I have an included file which does that MMA, the multiple moving average, the red, the green, the blue, the red, the green, the orange, the pink. And if I run this against the SX300, I'll do it for, get out of the way. Oh, yeah. Just for curiosity, 500 bars would be 10 years. And if I run that, that's done. That's amazing. This is so fast. That's 10 years of back testing. And that's not what I was expecting to see. 145. Oh, yes. Oh, sorry. My bad. That was daily. Let's do that again with weekly. So that's again 500 bars tested. Let's get this back. So there is the equity curve for that set of code. The green line is the equity curve, and the red line is the XJO, which is up 46% on 10 years, something that's had a pretty parlous time. So that's optimized parameters to give a huge rate of return, 97% per annum rate of return. This has got some quite bizarre, and bearing in mind this is me playing, it's got positions only two within the portfolio. So this is a high risk strategy, but it gives enormously good returns. There's the 1040, that's the position score. If I want to change this, for instance, to say, let's test with 5 in the portfolio. Very simple. Change that to 5, buy that, test it. And you can see that with 5 in the portfolio, it's nowhere near as good. It's about half the performance, but it's still giving a profitability of 500,000 compared to 100,000 for the index. you'll see here, and this is a good example, these flat lines are what you like to see on equity curves when you have bad market times and you're out of the market. So this flat line here is a direct result of applying the multiple moving average market limiter. And you can see here, when the XJO has been sort of drifting downwards, not necessarily dramatically, but it's been going downwards. You're better off not being in that. And this has just gone flatlined. Here, it's flatlined when the market probably is flatlined as well. Here, this is the COVID drop. Here, it's flatlined. Arguably, some would say, "Oh, well, I'd rather we were getting some of this," but it cuts in back here and picks up from here and picks up a huge jump over that period there. So that, for those that are interested, that's what real test can do. The complete output is here, so you'll recognize this. This is very similar to Amy Broker. Here is the month-by-month analysis over that 10-year period so over that 10-year period, there were 2 years that showed negative returns, one of 16% and one of 2%, and an average of 40% per year over that period. And then there's the equity curve, there's the drawdown. Some quite big drawdowns at time, but bearing in mind those are on a particular stock. So that was 5 stocks at that time. There, one stock has had a drawdown of 38%. So that's 1 out of 5 has gone back by 38%. That's at a stock level, not at a portfolio level, and all of that stuff you'd be familiar with. Monte Carlo is quite acceptable on that, and that's the code. So I'm beginning to get a bit deeper into real test, and if anybody is interested, I would recommend that they have a look at it. It's very poor on charting. So if I look, that's the trade list over that period, and if you click on a stock, that's the way the chart looks. It's a bit bare, and it shows you that stock, buy it there, sell it there. So it shows you the trade. Real test is just about the trading. It's not about pretty pictures. I would love real test to combine with BullCharts, and I think you would have a world-beating combination. The other thing that is world-beating about it is that it is lightning fast. So you can see how quickly it is to do the back test. If I download the data at the moment is being downloaded here from Yahoo. If I download the SX300 go back 10 years, it downloads all of that data in, I don't know, 30 seconds, something like that. When I update the data from yesterday, it's instant. So, and it's because it uses an in-memory database. Right. And that's the simple code that does that. If you're familiar with Amy Broker backtesting, Amy Broker, I think, is a little bit more complicated than that, but each to their own. Oh,
that's good.
Okay, there you go.
There is a question in the chat box. Philip has said, excellent presentation. Des, thank you. And Philip asks, what parameters do you use for your adapted weekly Guppy MMAs of the XJO?
Okay, I'll show that. Have I still got the screen?
Yep.
So I'll just pull up the code for the those are the parameters there, and they are exactly the same as Guppy uses, but I use weighted. Oh, and I'll show this. Yes, this would be of interest. Within BullCharts, there is obviously Guppy is in there. Guppy does have a trend ribbon, which I thought I had on mine, but if I pull it up, I can do that. So insert indicator. So this is Guppy's trend indicator according to the way he uses the MMA. I'll put this onto XJO so that we're looking at the same thing. So the colored one, the ribbon with all the colors, that's my version of the MMA, and that's when I say green is definitely in the in an uptrend, and red is definitely not. And then these in between areas. What Guppy does is he takes all of the multiple moving average values and he sums them. So he sums the absolute values of all the green lines. He sums the absolute value of all the red lines, and then he compares them. And that's how he comes upon this bullish and bearish ribbon. As I said, I do it somewhat differently. I look to define not so much their absolute values. I look as to the shape of the values as to whether they're forming a gap or not. And under the Guppy version of the world, he would say you're still in a bullish market through here. And I would say doesn't pass my sanity test. So he would say, Guppy, basically you're through for most of this. He picks that this is a bit bullish, and that's where I got this little false trade in there. So you can do whatever you like. This is down to you. I do it this way. I think it better reflects what the market looks like to me. You can see in some areas it's actually they're quite close, but in other areas they're not at all close, and that's what I do.
Very, very good. I think that answers Phil's question. Are there any other questions?
Yeah, thanks very much. Yeah.
No more questions. Des, thank you very much for coming along tonight and sharing that presentation again.
Okay, I just say if all the stuff's available, you'll put it up there. If anybody wants to contact me, emails on the presentation, please feel free. I don't mind helping. And in fact, what I have done in response to someone else's request, I've sent a couple of quite lengthy emails describing that scanning process. And I was thinking I might tidy that up into a little bit of a short written tutorial in case somebody would find that useful. I'll give that to you, Robert, and you can put it up there as well.
Yeah, Des, and that the material that you end up from that output, that might be useful in the knowledge base. So if you think it's a tutorial type or explanatory type thing that would be useful in the knowledge base, send it to me and I'll post it up into a new knowledge base article.
Okay.
Yeah, that'd be good. Now we've got two more questions. David says, Robert, can you show index builder where it is found on menus? Excellent, thank you so much, Des. Okay, Des, can I take the screen back?
You can indeed.
All right, thank you again, Des. Make me the presenter.
More than welcome. Good night, everyone.
Yeah, we're hanging around for another couple of minutes. So.
Oh yeah. I'm going mute.
Very good. Thank you, Des. And in the chat box, someone's asked about index builder. From the menu, if we go insert indicator, Control I, then from all indicators, scroll down this list till we get to the eyes and choose index builder. And on index builder, we then have the opportunity to specify 5 stocks. And if I just accept the 5 that are there with the multiplier of 1, click next. Let's put them on a new pane. And there is one curve which is essentially those 5 stocks aggregated into one mini index. And in the top left corner here, it tells us which 5 stocks they are. So that's the index builder that I mentioned we talked about 2 weeks ago in the Melbourne meeting, and someone's just asked about in the chat box. If you find a use for that, it'd be useful, I think, to share it and explain what you've got there, because I'm not sure I can find a good use for that just at the moment. Going back to the agenda, we always offer the opportunity for people to ask questions about bull charts, ask questions, how do I do this, or how do I do that, or is this available, or to share something they've found. So this is that point in the meeting. We'll spend a couple of minutes doing that.
Robert, David here.
Yes, David.
Robert, I find when you're using multiple moving averages, Alan Hull's got quite a good multiple moving averages, which allows you to, say, change from simple to exponential or weighted, because I noticed there's using weighted, and you can sometimes put it up on a chart, and you can change it and see which. I'm a bit like Des. I like to see which way the moving averages are going. So I tend to use Hull rather than Guppy.
Robert, there's a Guppy custom multiple moving average indicator, and that one allows you to change all the values.
Oh, does it? Righto. Oh, righto. Same thing.
Yeah, same. In fact, I start with those, but I rip all that parameterization out to make it run better, and when I know what I want, and typically I'll use weighted. Yeah, there it is there.
Righto. Answered.
Yep. Okie dokie. Very good. Oh, that changed. Yeah, okay. That's good. For anyone watching that, the Guppy multiple moving average and the Hull multiple moving average are very similar, and I'm not sure which one of those 2 gentlemen would claim to be the first to prepare and share the multiple moving average that we see here. One of them might claim it was their idea. I'm not sure. Next time, yes. Anything else, anyone? If not, we will meet again online here a week after the Melbourne meeting. It'll be the week after the 16th of August. It'll be the 23rd. And I would again like to thank Des for presenting tonight, taking the time to put that together and to be here tonight and talk. Last opportunity to say something, input, feedback, or you can email me or phone. If not, good night, everybody.